Thank you, Debbie, Peter, and Michael. Our next panel will address the impact of tax reforms and trends on transfer pricing. What is the future of the arm's length standard? And from a planning perspective, how does transfer pricing dovetail with the BEAT, GILTI, and FDII? Our panel includes the three S's: Sean Foley, Stephen Blau, and Sam Maruca.
Thank you, Larry.
From your left, Sean Foley is a principal with KPMG's Washington National Tax Practice and the head of KPMG's Global Transfer Pricing Dispute Resolution Services. Before joining KPMG, Sean was the director of the IRS Advanced Pricing Agreement program. Sean has been involved in over 300 APAs, both with the IRS and an advisor. Sean is a past chair of the American Bar Association Transfer Pricing Committee and has taught in the tax LLM programs at the University of Florida and Georgetown. Stephen Blau is a principal with KPMG's Washington National Tax Practice and is the firm's senior transfer pricing economist. Steve has extensive experience with transfer pricing for some of the world's largest digital economy and other technology businesses. Sam Maruca is a partner with Covington and Burling with a concentrated focus on global transfer pricing. Sam served as the first director of transfer pricing operations at the Internal Revenue Service. Sam is the author of Transfer Pricing, the Code, the Regulations, and Selected Case Law, BNA Tax Management Portfolio 886-2. Sean.
Thank you, Larry. And welcome to transfer pricing. This is our favorite topic, and I know that it's not everyone's favorite topic, but it's one that, unfortunately, everyone has to spend time on. I know that. But so today we're going to focus on three aspects of, as Larry said, we're going to spend some time thinking about BEPS, and particularly BEPS 1.0, and what that has sort of laid out for companies and tax practitioners, and how it's changed the landscape, and our most recent experiences with this sort of out there in the world. Then we're going to spend a little bit of time on the digital economy, particularly focusing in on the arm's length standard. And we had a little bit of that earlier today, but I think Steve in particular is going to give us some important insight into some of the thinking that we're doing around the digital tax and some of the market intangibles and some of the others. And then we're going to finish up actually sort of following on a little bit what just happened in this last panel. We're going to talk a bit about how FDII, BEAT, and GILTI and some of the tax planning and non-planning that's going on as we're talking to companies about tax reform. So with that, this is our next step in the whirligig, and so we're off to the races. So the way I've set this up is I've got in my mind, if I'm talking to or if I'm a client, if I'm the taxpayer, I'm thinking about, quite often I'm thinking at the end of the quarter, I'm thinking about the end of the year, I'm thinking about my tax provision, and I'm wondering, what is going to make this thing explode in my face? What danger do I have out there? And is it BEPS related? And if it is BEPS related, how is that actually going to make that come? That's really where it often hits the road first, is on the tax provision. But of course, driving that is what's happening out in the world of audits. And so, Sam, why don't you tell us a bit about what you're seeing and why you think you're seeing it?
Yeah, Sean, happy to. So I've been practicing mostly in the transfer pricing controversy area for quite a long time. And as I look back, the vast majority of that was IRS related, it was domestic. And in the last couple of years, my plate has become increasingly full with foreign initiated adjustments, which brings me squarely up to, what happened at OECD back when they changed the transfer pricing guidelines, and I think it's fair to say a lot happened. And I guess the bottom line is what I'm seeing out there is, in my view, often very inconsistent with what I think is the correct reading of the transfer pricing guidelines as modified during the BEPS process. So there's obviously a lot more scrutiny around the world on transfer pricing. 10 years ago, transfer pricing was a sleepy area that we cared about.
Well, the U.S. cared about it, for a long time.
It wasn't mainstream press kind of stuff, and now it is.
That's right.
So a lot of scrutiny. Companies are having a lot of difficulty maintaining consistency. So if you have an IP holding company, typically you want to try and charge the same royalty no matter where the property is being exploited. That's becoming increasingly difficult to do because governments are aware of what's going on in each other's shops. And dispute resolution has always been a problem. There's a lot of talk about dispute resolution, how important it is to companies that they get certainty that process works, but little evidence, in my experience, that governments are willing to make the kind of investment that it takes to have effective dispute resolution. So kind of a perfect storm. But just to talk about the law a little bit, there's an unfortunate sort of macro tension, I think it's safe to say, in the changes that were made to Chapter 1 and to some extent to Chapter 6 of the transfer pricing guidelines. And it's this tension between, on the one hand, contracts and funding. What does the paper say? Where's the money? And on the other hand, it's people functions, control over risks. And this is like making sausage because you're trying to satisfy a lot of writers in the process, and there's a lot of stuff that probably should have been on the cutting room floor that ends up in the regulations or in the guidelines. But suffice it to say, there's this ambiguity that kind of blends, in my view. It's almost like Article 7 concepts, AOA, et cetera, have been imported into Article 9, which is, at least in theory, separate entity accounting. Each corporation is, its own standalone tax entity, et cetera. But in my read, and I was there when this was written, and I know that there were countries coming at it from radically different viewpoints, but it says pretty clearly that you start with the contracts. And if the contractual allocation of, let's say, risk or responsibility is borne out by the party's conduct, you're done. And in particular, when it comes to control over risk, if the contractual owner has both the financial capacity to fund the risk and controls the risk, again, end of story, we're done. There may be other parties, related parties, to whom tasks have been contracted. They contribute to the management of risk. They perform DEMPI functions at some level. But the rules make pretty clear that you can delegate. That's expected. And that if you do have a party that's not the owner and controller, they could be paid a lot of money, but they're being paid as a service provider. They're not an IP owner. So I think that reading is pretty clear, but what I'm seeing out there is something quite different.
So Sam, one thing that I think, because we basically this whole concept of DEMPI and the idea of substance and, as you said, sort of stepping back from contracts. One of the concerns is that at least what I'm seeing internationally is even more two-sided analysis. The idea of one-sided analysis is getting more and more difficult to sustain. And then secondly, the issue of as a part of an audit, and this is relatively new, is looking at the DEMPI functions in your country. For example, I think we were talking about Germany, for example, we'll be doing an audit, and and you're looking at what you would think of as being a fairly straightforward manufacturing operation or distribution operation, but they're wanting to know, can I find some DEMPI, here in the borders? Absolutely. And if I can, then I'm going to go to town on this company. And so it's really become, a bit of a fishing expedition in some places.
Yeah, that's exactly. Maybe you can switch to the next slide.
Yeah, and I would just say, while we're doing that, I mean, from my perspective, what we're seeing now, I think, on audits is something that a lot of us saw coming very quickly after these regs came out, right? Because there is, really what we're seeing is this issue where you've got some risk control functions on both sides of the transaction. you have a contract that gives a one-sided risk allocation. There is a paragraph in Chapter 1 that seems to say very explicitly, and many of us thought that's what it said very explicitly when it came out, that in that situation, that's enough and you can respect the one-sided allocation of risk in the contract. I started hearing very soon that there were countries that did not agree with that and pointed to another paragraph later in the guidelines, which not quite as explicitly they read as suggesting that no, in that situation where there were two sides controlling the risk, that you actually didn't necessarily, you at least potentially gave a profit split to the folks on the other side of that. I think, just as an observer, the fact that the words and the guidelines that were consensus were papering over a fairly significant difference in views on that, I think, came out very clearly in the discussions on the attempts to rewrite the profit attribution draft, where that really just got really wrecked, I thought, on the fact that countries didn't, they were trying to set up some examples that had that sort of split risk allocation, and countries couldn't agree on what that meant. So now that's sort of been there, that we knew there was that disagreement, and what you're describing is really, well, we're seeing that now on audit, right? We're now seeing on audit that when you've got high-level functions in both countries, that the country that is being put on a TNM doesn't want it and wants more.
Yeah, and it's particularly troublesome. A lot of companies now are matrixed in their management. And it's not, where you sit, it's what you know. And so you can have, like, an IP holding company with an executive board and not a whole lot else in that country, say Ireland. But that board is very definitely in control of the risks because, let's say it's making the decisions, but there are other inputs because that team managing the IP may be dispersed across the globe. They're definitely being led out of the IP holding company. But what you get are these local countries that'll say either you have a PE by virtue of this person sitting here and participating in this activity, or we're a part owner of the IP because we're controlling risks through Joe Small, who's reporting up. But hey, this is a guy making important decisions, and we get a piece of the pie. And as you point out, that leads inevitably to some sort of a profit split analysis. But maybe the one side method is going the way of the dodo.
Well, although I say, in my practical experience is that profit splits are threatened, but it's difficult for outside of India, where it's all head count and that all works, right? But it's been my experience that they're sort of threatened and they're used as a way to sort of juice up a super return, ultimately on a TNMM basis. I think that's been my experience. Sam, is that sort of how you see things?
Yeah, we see both. We see both an assertion that we're an owner, effectively, of the IP. That's the way these rules should be read. But often there's a negotiation and it results in a super distributed return.
Yeah, right, exactly. I think that's and then the other sort of, at least I think is important, is coming out of BEPS is really, of course, transparency. And the C/C audit, which is, I was just telling you guys that we were waiting because we're all expecting, I think everyone out there, you're all expecting a wave of audits coming at you as these C/C reports wind up on the desks of auditors around the world. And actually, just at a couple of conferences, I was just over in Europe this last couple of weeks, and we're now aware of 2 audits that opened up, one in Austria. And actually, interestingly enough, the Austrian tax authority, this was a Swiss inbound into Austria, and the Austrians actually immediately gave us a proposed notice almost immediately based on head count from the C/C report, something they're absolutely not supposed to do. And so that was they're just right out of the bat, just wrong. The other one actually it's a large French multinational, and the way this came to everyone's attention was that the French tax authority sent out 80 IDRs to 80 countries, presumably on the C/C report, asking all kinds of detail about the C/C report. So that just all went out in the last 3 or 4 weeks. This is all just starting to happen. But it is, I mean, the reality, I think, is there today. So that's another important thing. But what are you seeing in the U.S.? And how do you think that plays?
Yeah, so I'm seeing indications that this BEPS type thinking is creeping into U.S. enforcement. And just looking back historically, I think it's fair to say that the IRS's focus, certainly when I was there, the focus was on mispricing. You know, are you selling the IP or, transferring IP in a controlled transaction for the right price? And we didn't really care whether it was a man and his dog on some island that was actually exploiting the IP, as long as they had the money and as long as they were a real company, we were done. But now what I'm seeing is exam teams looking at things a little differently. So just for example, one case where there is an IP holding company, a CFC, a US company, and for a decade or more, 3 or 4 audit cycles, the IRS and the taxpayer have agreed that that's the right characterization. IP owner, distributor. Argue about what the right return is to the distributor, but ultimately resolved on the basis that that's the appropriate characterization or delineation of the functions, assets, and risks. Now a new team has come in, they've taken another look at it, and they've provided a model that basically flips that and says, in effect, this is just a cash box. It's a creature of the US company, and we're going to assign it a risk-adjusted return, and everything else comes back.
So two things about that.
That's the first time I've seen that. So
what years are we talking about? What years are being audited, just roughly?
This is about 5 years ago.
5 years ago, okay. So we didn't have DEMPI even defined 5 years ago. And then secondly, there have been no changes to the US rules, right?
Correct.
So, I mean, this is troubling and to be expected, I guess.
Yeah, so in terms of the US rules, in the transfer pricing guidelines now, there are, I don't know how many paragraphs, maybe 100 that are devoted to the allocation of risk and control over risk. The US has one paragraph, I think it's buried in the comparability section.
Yeah, I think that's where it is.
That talks about control and a party that has more control over a function or a risk is normally going to earn more money, or that's basically what it says, but it's put in terms of comparability and not in terms of IP ownership necessarily. And similarly, in the cost-sharing space, I haven't seen this kind of attack from the IRS in the cost-sharing space, but in cost-sharing, those of you who are old enough to remember, there was proposed a active trader business requirement for participants in cost-sharing. That ended up on the cutting room floor when the regulations were finalized. So they thought about it and didn't take that step. We'll see if, maybe old cost-sharing arrangements come under some sort of stress now. But anyway, in this particular audit, one of the real concerns is they're now asking us to go back and reconstruct how this product was developed, acquired back in the 1990s.
Yeah, I mean, because you're going back through a whole development cycle.
Right.
I mean, you're starting 5 years ago, and then you're going back 15 years from that.
Right.
Yep.
And
Very,
then
very tough.
the last point here, and then I'll move on, is where Steve can take over. You mentioned this bracket, I call it bracket creep. We're seeing a fair amount of that, and I don't know whether that's a function of the US watching India scrape off 15, 20%, or watching the sort of rent-seeking behavior of other tax authorities and is following suit. I want mine, but it is suggestive that there too there's some increasing pressure on what we've always accepted as kind of a normal way to look at transfer pricing.
Yeah, yep. Big changes.
I guess one of the things, Sean, that's happening on the U.S. side is now APMA has this profit split model that they've put out that they're asking taxpayers in APAs, in many cases, to fill out this indicative profit.
Well, we don't know how many cases yet.
We don't know it, yes.
I mean,
we don't know how many,
but
but
they
put
call
it
it the functional cost diagnostic tool. And it's an Excel model that was built by the Atma office, and in some cases they're asking the taxpayers to come in and fill it out so that they can figure out what a profit split would look like, based on that taxpayer's facts. So it's a very important development, but
There is,
broad.
and I believe there's a focus in there on people functions, which is interesting. Now, of course, Atma's playing in the OECD space,
Right.
so that's not surprising, but that's, I think, inevitably going to creep in as it appears
It already
to be
has.
doing. Yeah,
It already has.
yeah.
Yep. Well, let's turn our attention now to what I think of as I was trying to think of a way to talk about the ends of the arm's length standard in a way that you hadn't heard before, and so I decided to go with the ring cycle and got it on wrong. So we've got this. So is this the end of the world from the arm's length standard? Are we really ready to ring the alarm bells, Steve Blau?
All right, well, I backed off a little bit on Goddard Emerald and just went for the camel's nose being in the tent. So as Sam was describing, so I think a lot of us thought, even as recently as a year ago, and we heard some of this in the earlier panel, that we now had a new set of at least consensus words on paper in the transfer pricing guidelines. And I think everyone understood it would take some time to evolve how those interpretations were happening among different tax authorities and evolve how things would be settled in competent authority cases to avoid double tax. We have not had any time to adjust to that hoped for equilibrium before getting hit by a new set of, by basically and again, we heard about this morning, essentially a almost definite declaration that no, we are not in an equilibrium. We need yet new and even more major changes to transfer pricing and related matters to get to something that tax authorities are happy with. And again, we heard
Consensus may be even harder to.
and the consensus may be even harder. So I want to talk about that a little bit, and I want to recap what we heard on the digital economy panel this morning. Other than to say, we've got to stop talking about this as digital economy proposals, right? Because as we heard from Brian Jen, the U.S. government's explicit position here is that the one proposal of the Pillar 1 proposals that is limited to the digital economy is a non-starter from their point of view. And the U.S. government has put out a proposal, the marketing intangibles proposal, which is explicitly applied to all kinds of companies, a very broad proposal. And it's also, I think, pretty clear consensus that if any of these goes forward has a chance of getting consensus, it's that marketing intangibles proposal. So this is not about the digital economy. This is about how we are modifying the arm's length standard to meet the demands of jurisdictions that want more money attributed to where the customers are.
And I would say more money than they would be entitled to under traditional application of the arm's length.
Right, if they thought they were getting enough under traditional application of the arm's length standard, we wouldn't be doing this. So I think that's one very important point here. I think the second very important point here is, all three of these Pillar 1 proposals are move away from the arm's length standard. I think even if you look at the marketing intangibles proposal and the most, I would say, conservative interpretation of that, as Brian talked about this morning, there's a big push on that to do it on a, quote, simplified basis, at a higher level of aggregation. Well, that in and of itself, in my mind, is necessarily a move away from the arm's length standard, because the arm's length standard is necessarily a transaction by transaction analysis that is based on the specific facts and circumstances of that transaction. If you do this on any kind of a simplified basis, you will inevitably and necessarily end up with results that differ from what you would get on a arm's length transaction by transaction analysis. All three of these proposals also place a lot of emphasis on transparency and ease of administration and diminished emphasis on fact-specific determination. Again, that this is, you understand where tax authorities are coming from on this. That they feel that tax, we've always heard about this, about the disadvantage tax authorities have about taxpayers always, because taxpayers have much more detailed commands of the facts. And just the fact that transfer pricing is based on these very factual specific determinations, in some ways, tax authorities believe that in and of itself biases the results against them. Now, importantly, the user participation and the marketing intangibles proposal suggest that their proposed allocations will coexist with using the existing arm's length standard methodologies with respect to attributing, quote, all other profit, or with all other transactions. And so the question here that I think bears a lot of thought, because this is what's being proposed, and this was a big part of this marketing intangible proposal, the way it's being sold, is that don't worry, we're going to take a modest piece of profit, allocate it on this simplified basis according to where the customers are, but don't worry, everything else will be business as usual based on the arm's length standard transfer pricing. So the question I want to raise fundamentally is, can that hybrid model that combines the arm's length standard and some non-arm's length standard profit attribution achieve both this administratability goal and also reach a consensus that, as Sam pointed out, has not been achieved by BEPS 1.0? Can we get there? And we go to the next slide here. So I'm going to talk a little bit more about the marketing intangibles proposal. So just level set here, we've been in a world where we're focused on avoiding double tax. And to avoid double tax, the amount of profit attributed to the marketing intangibles and the jurisdictions where that profit is attributed, we need to have agreement on that. And there's been lots of discussion on that. That's a lot of focus. That's what you hear a lot about. What you've heard less about, I think you really need to put a lot more thought into, is we need consensus on the jurisdictions where the corresponding deductions are going to be, right? So we're saying, oh, we're going to have this simplified way of computing how much marketing intangible profit goes to each jurisdiction where the customers are. Well, who gets to deduct that? That may not be so simple. And in particular, when we talk about having administrative simplicity, the question I would raise is, does achieving administrative simplicity on the first step, which is where the income go, does that just push complexity into the back end, which is deciding where the deductions go? And then, of course, we also are going to need effective dispute resolution mechanisms, to avoid double tax, because now, whenever you touch any piece of this, you're going to have ripple effects through the system, and are we going to need effective multi-jurisdictional double tax dispute resolution things to avoid double tax?
And that's a really important point, Steve, because as you said, maybe we can reach a consensus that there's some kind of formulaic. We actually formulaic in two ways. One, the amount of profit that's going to be subject to this marketing intangible division, and then the formula itself. So maybe there's a consensus around that. But that concept has a concept of a residual, and as soon as we touch the residual, then the amount that is going to be spread around 80 countries is suddenly changed. And if suddenly you have to claw some of that back, how do you get refunds from 80 countries? How do 80 countries come together? I mean, the idea of even 3 countries coming together to do this, would be extraordinarily difficult. And just thinking about the C/C reports and the fact that everyone understands that we're in multiple jurisdictions. This is going to be a real problem. And just trying to think about even how does arbitration, for example, if you actually decided to go with arbitration, you just every country put an additional arbiter on there, and then do they come together and the principal has 1 arbiter and the distributors have 15 and the manufacturers have 6, and so who wins? Well, the distributors won. They all just voted. I mean, it's just thinking about how this could actually play out in practice is really
I have a
really
very
difficult.
constructive proposal for that one, which is that what we need is a global stable of well-paid, retired transfer pricing experts from Big 4 accounting firms to
You're
resolve these
volunteering?
arbitration disputes.
No, it's interesting. I was actually at the consultation, which was fascinating. And the sense of the room was, A, no ring fencing. This has got to be something that's
Steve's
broadly.
original point, yeah.
And 2, it's now an inclusive framework. So when Working Party 6 developed the transfer pricing guidelines, it was 40 countries around a table, mostly highly developed economies. The inclusive framework is 129 countries, some of which have no infrastructure, 0, around corporate income tax. And so how that's going to be driven to, some sort of rule does suggest that it's going to have to be pretty simple. It's going to have to rely on readily available data, like overall profitability of a company, et cetera. Because otherwise it's going to be unstable. You're going to have disputes all over the place. But the other thing, and this is on the plus side, is I think everybody thought that the solution has to be pretty modest.
Yep.
We're not talking about allocating a whole hell of a lot
That's
of the
that's a key
residual
point.
profit.
I would love to hear what Brian Jen's idea is of what's a sliver. I mean, we hear that, right?
We want to hear about that. Let me just, I've got a couple of examples up here just about some of the conceptual things that come up, though, just again on my point of, well, let's think about where the deductions go, not just where the income goes. First one,
We'll go back. Okay.
I'm not quite done with this yet. Very simple as possible, almost simple as possible example. We've got two regional, simple company, one product line, two regional principal companies. Sounds like fine, the marketing intangibles deductions for the countries under one regional come out of that one's pool of profit, from the other territory come from the other one's pool of profit, makes lots of sense. Except that, and this is not an uncommon fact pattern, principal one pays a brand royalty to principal two. Well, this is probably a readily solvable problem, but you got to figure out, well, is that brand royalty associated with the marketing intangibles income? Is brand royalty sort of a piece of marketing intangibles income? So now all of a sudden, we're going to have to reduce that brand royalty because some of that's being allocated to the marketing jurisdictions, and we're suddenly no longer using cups to establish the value of brands, or are we saying marketing intangibles are something apart from the brand? So you're going to have to deal with that conceptual difficulty. Another one, going to example two, and this is, I think, going to be a very common fact pattern, and the one that I frankly lose sleep over, is, again, trying to keep it relatively simple. You've got two product lines, okay? Those product lines have both different levels of residual profit to them significantly within the enterprise. They also have very significantly different footprints with respect to where their customers are. So if you did the marketing intangibles analysis on a product line by product line basis, you'd come up with fairly different answers for them. But in the interest of administrative simplicity, because of the way the data are maintained at the company, we're going to aggregate them two together. We're not going to recognize the difference between those two profit lines in doing our marketing intangibles calculation. Well, now all of a sudden you've got some very interesting issues to work through in terms of, okay, where do those deductions go and how do those affect the underlying transfer pricing for those products in those two product lines, where all the other analysis, all the other transfer pricing is being done recognizing the difference in the separate transactions and profitability of the profit line, but we're moving a bunch of profit around under marketing intangibles that's throwing the two together. So you've got some very interesting issues that are going to need to be worked through. If we're going to get consensus on this, I frankly hope they do, because again, I think a lot of folks think that in order to get consensus, this is the only path that's going to get there. But Sean, I'm going to just close this section with, we don't have the clickers, so we can't pose these to the audience, but just here's my dystopian, sort of dystopian view, which is that, so if we think about tax planning for the last, certainly since I've been in the business, has been premised on two things, I think. One, at least in the transfer pricing, premise number one is there are significant rate differences between jurisdictions, so we care a lot where we get our income recognized. And number two is that we have effective double tax resolution. Well, then planning, is we've all been doing it, is all about optimizing our footprint with respect to recognizing as much income as we can in the lowest rate jurisdiction as we can. Well, imagine a situation where 5 years from now, we've had real trouble getting to consensus, and we've got a lot of double tax risk out there, because settling double tax disputes is really, really difficult because we've got these wide differences of interpretation of regulations. Further, potentially, we have significant squeezing of rates. We've got a lot less rate differential between, say, the US bringing down rates, other countries bringing down rates to be competitive, and flip side, blacklisting countries and otherwise, and putting in min tax regimes so that very low rate strategies don't work either. My question is, and I'll pose it to Sam and Sean, is what do you think the chances are that 5 years from now planning is going to be much more about planning to avoid double tax rather than planning to get as much income as you can into the lowest rate jurisdiction as you can?
Well, I think certainly the pendulum has swung. It's swinging wildly. The days of stateless income are numbered, and that may be replaced by a world of double tax. So we go from double non-tax to double tax. I think there's a high likelihood of that.
Yeah, and I'm a little more optimistic because I do think that there is. I think there's going to be a strong push for consensus. I think that there will be. I do think there will be consensus that comes out of the digital effort, and it will be. And I guess ultimately, I believe it will be largely implemented. But I do think that that the idea of planning around to avoid double tax will be a much more important part of what we are doing and what companies are asking us to do. But it will be within. I do think it's not going to be within chaos. I guess I have some hope for that. But you know, I'll come back here in a couple of years, and you guys can just tell me how wrong I was. So. Our last sort of part of this was tax reform, and we were, you know, one of the things that we wanted to sort of highlight is what is planning like with transfer pricing? I mean, Steve, you know, we just sort of at a high level just put that out there, is that this was the type of planning we used to do, but now, you know, is transfer pricing no longer an important part of planning? And sort of thinking about that, you know, just. The issue of arbitrage, Sam. This is supposed to tell us about the idea of the 21% is our cornerstone of our new regime, and obviously that's an important change.
Yeah, that's certainly. I think if you had to pick out one change that was biggest for transfer pricing, that was probably it, because it really, between that and the end of deferral and GILTI, there's just a lot less room to play. So the glory days of income shifting are clearly gone. On the other hand, it's going to be critical to plan out of double tax if you can. And there's also going to be some room to maneuver when it comes to how much income belongs in which of these new baskets. And that's definitely going to involve top line, a transfer pricing
Yep, exactly.
issue.
Yep. And then Steve, you know, as we've been talking about planning in this new world, you know, we've got these you know, these major you know, pieces of the puzzle, and this slide is supposed to show you that they're all interrelated. And so you know, how are your teams been attacking that?
Well, I think the main thing, honestly, it's modeling, because when you can't anymore look at any particular provision in isolation from the other provisions. You can't look at. In fact, I've pretty much lost my campaign to just refer to GILTI and FDII together as GIDDI, but again, you know, when you want to think about, you know, what you're doing with transfer pricing, how your transfer pricing is going to affect these provisions, you know, given, you know, just a simple thing like the impact of lost jurisdictions, you know, on your GILTI income is huge, and transfer pricing obviously has a huge effect on that. But what we found every time we sit down and try and build a model to model stuff out for clients, almost inevitably you get some sort of weird and unexpected result that just kind of thinking through intellectually, well, I've got FDII, and so does this make me want to, you know, what is the effect of this on where I should put my income, is just not obvious, not something that you can think through, you know, as a finger exercise. It's something you've got to sit down and look at your facts, look at your tax attributes, and think about not just, you know, optimizing on the margin of where your intangibles are sitting, but, you know, how you're managing your transfer pricing to, say, make sure we get rid of losses. And then, you know, all the other pieces, non-transfer pricing pieces of this, like the affirmative subpart F planning that we were talking about earlier as well. You know, all of these pieces interact together, and you can't just do we don't have bullet strategies anymore, I don't think. Every strategy is looking at every piece together.
KPMG has got a big, you know, sophisticated, you know, tax model that we put together. So how does Covington handle this kind of the modeling? Because I guess
we don't do a whole lot of that, but we're thinking about acquiring one of the big four. So Steve, we can talk maybe after the panel.
But I guess it is the point is it modeling, and that's at the core of what transfer pricing planning is today. And then
and I would add, by the way, the same thing happens when people, because we've got companies are very quickly starting to try and figure out what modeling, you know, trying to game out what this marketing intangibles proposal might be and what it might mean for them, and they're finding exactly the same thing, which is you get really weird and counterintuitive results out of those modeling exercises that you need to really sit down and spend some time on. So
yeah, very important. So then we're talking about some of the specific aspects of how, now we're talking about the bullets that we use because we always have to sort of bucket things ultimately. But Steve, you've done a bit of beat modeling, or not so much, or trying to sort through some of the, because I would say that this is probably the front and center, the part of tax reform that in the transfer pricing space that we've had the most pressure, I think, immediately. FDIC seems to be coming a little bit slower, I think, in major part because I think companies have been skeptical about whether this is long term, and then GILTI is sort of also maybe a little bit harder to get to, but BEAT seems to be front and center.
If you had told me when the services regs came out in 2008 that in 2019 I would have 3 phone calls, and the second half of 2018 I would be on 3 conference calls a week about the interpretation of the services cost method, I might have said, I'm going to make sure I retire before then. But yeah, I mean, the SCM, of course, was never intended when it was written as being it was all about inbound, right? It was all about outbound services charges, not about inbound. And now, Congress in its wisdom,
And it was all about taking controversy off the
it's
table.
all about taking controversy off the table.
Now.
Yeah. And so now you've suddenly got a situation where, so SCM was originally about, we don't want to argue about whether something deserves a 5% or a 4% or a 6% markup, just charge it at cost and we're fine. That's not something we worry about. Well, now all of a sudden, whether something is SCM eligible is not about a 5% margin, it's about the deductibility of the entire cost base. Right, so it's all of a sudden it's bearing this load that it was not designed to make, and and particularly when you get into this, clients I love the analogy of clients telling me, yeah, we're at the stage of searching through the couch cushions for loose change to try and get under the 3% threshold. Right?
Of course.
Yeah, the cliff effect is just amazing and really puts huge pressure on us with respect to coming to these SCM conclusions.
Then it's a little bit startling how the blacklist is actually wound up being actually a lot harder to interpret. I mean, particularly the one around distribution. I mean,
I think all we have is a dictionary that I'm aware of.
We've tried the dictionary. Sean and I have had long debates about the dictionary and what distribution means with respect to that particular blacklist item.
Yeah, it's just crazy. And of course, in the main, we never had these kinds of questions that were coming up because we had the business judgment rule, which basically took anything interesting off the table because that all your interesting transactions were out because they're core to your business. And now it's all exactly those same interesting transactions that are clearly back on the table because we've taken that off. And now it's. I think you're quite right to say that we're struggling with a regulation that was just not designed to carry this kind of weight. And now, of course, it's actually locked into law because the law references the regulation as written on the date of enactment and cannot be changed without statute. So that's not even an area where they have authority to really modify this in a material way.
And of course, we have some interesting controversy implications. For example, situations where a foreign adjustment could be something that is either a nothing to the IRS or is actually in the U.S. fisc's favor, in the case that actually put a company over the 3% threshold. So.
Yep.
The beat is a wonderful thing, as we've heard about it. I don't think we need to spend any more time talking about the wonders of the beat since we heard about it.
Now, on FDIC, there was the idea that the new regs have been proposed, and I think as the concept here is saying that the qualification has gotten very onerous, and potentially the documentation requirements here might even be an impossible lift. Now, hopefully, some of this will be addressed, when through comments and the final regs. But I guess the area that we're sort of looking at is something that expense allocation, and particularly, are we able to revisit some transfer pricing, perhaps to increase the inbound charges, the inbound piece of the puzzle to take advantage of FDIC. And then secondly, to the extent that, and this is also obviously for GILTI, to the extent that you can identify perhaps on a better scrub some of the headquarter charges that are winding up, in the 861 allocations that are really kind of, hurting these things. Are there ways to sort of revisit some of that? I guess those are a couple of places that I think we do, anticipate some work.
Yeah, the real problem there is you have to live with your history.
Well, unless you don't,
You may have had some services that you priced at 8%, 9%. Now all of a sudden they're 7%.
Yeah. No, but I think you've got some interesting tensions there. But I think one thing that we've talked to a lot of companies about is you've got these big headquarter U.S.-based multinationals have these big headquarter cost allocations that go into what's their stewardship number, they go into what are their charge-out numbers, they go into their, a whole bunch of different things. Well, those things now, many companies' businesses evolve, so you may have a good business reason to revisit those things. They're hard to maintain anyway. And now those things all of essentially every tax implication of how you bucketed those charges has changed because you have, different implications for the stewardship charges. You have implications for your foreign tax credit baskets, as well as your BEAT characterizations, et cetera. So those are an area, for a really close look to take into account in terms of whether you want to refine those.
Yeah, and I think I think my last slide actually did not get picked up. I had a GILTI slide that just disappeared here. Larry. But the thing that I think is important, at least one aspect of GILTI that's important to think about from transfer pricing is, and we've heard about it repeated several times here throughout the day, is the fact that the tax credits are expiring, in the year of. In the year in which they rise, and as a result of that, is that it becomes that your tax credit planning is becoming very, very fine-tuned, and people, as we also have heard, are talking about going to subpart F, affirmatively, really, thinking through in a very detailed way how in which the way the credits are going to play out across all the baskets, but ultimately, in order to have that planning be effectuated, you're going to have a stable transfer pricing regime, because if there's a challenge to it, 2 or 3 years later, the French tax authority comes in, makes a big adjustment, throws subpart F income into a branch income, et cetera. Suddenly your whole set of cards that you'd set up there to get the best foreign tax credits are all knocked over, and suddenly those credits are just gone. And so I think part of where planning is going to be is not only thinking about it in terms of double tax, but at least until John Samuel's idea of GILTI being eliminated comes to pass in this future year. I think while we live with this, it's going to be important not only to have stable transfer pricing to avoid double tax, but also to make sure that the planning you're doing around tax credits is rock solid. Otherwise, it's all going to fail. And so I think that's a really fundamental point of where transfer pricing, I think, sort of takes us, in the next period. Any other thoughts about GILTI?
No.
Okay. Well, this is our open discussion, and we do have a couple of minutes for any questions. Anything on your minds about transfer pricing? Yes.
There was very, very little said about APAs in and I'm wondering whether the APA process can play a constructive part in getting, when Sam, when you said sitting around with 140 countries as opposed to 40, it occurred to me, well, maybe we can take some of the principles that resolve APA questions and apply them. Has there ever been any thought like that?
You mean with respect to BEAT, for example? Yeah, I know that is an issue that is under active discussion within APMA. And certainly at the very least, when you go into an APA process, you should go in with the idea of coming out with an agreement that has the best possible language it could have for purposes of BEAT defense, whether it's SCM or whatever. But absolutely, that's clearly a role that an APA can play, and I think APMA's always open to expanding their jurisdiction, in my experience. So they
I certainly was when I was running it. No, actually, we're aware, and I think Sam is alluding to this. We're aware of a couple of. I mean, I'm aware of 2 APAs right now where ATMA is looking at helping out and providing some assistance on BEAT specifically, and we've had some other conversations with them where they've said, look, come to us and let's discuss, at least in a pre-file or some other type of discussion about how this office might be able to assist taxpayers. So I think it is an important development, but the trick is still going to be, if you're thinking about a multilateral APA, that's still a really heavy lift. I mean, the famous one out there, years ago was Airbus, and and then they were able to do a multilateral APA, but the governments that agreed to the APA, they owned the company. So I've always wondered, is that really such an easy one? If they couldn't get it together, I mean, then they're the taxpayers and the owners, and they got it together. And that was a real, that in and of itself was a difficult one. So the multilateral aspect of this is going to be hard. And actually, I'm aware, though, so that there's an effort underway. There's something they're calling cross-border dialogue, which is an idea of having countries, competent authorities, and APA offices come together and have maybe an informal conversation. And I know that John Hughes is going to be at the American Bar Association in D.C. and we'll be talking about this. So there are some developments. I do think. I guess one of the reasons it makes me a little bit saying that maybe that we will have consensus and this won't be just chaos out there is that I am seeing some progress in the competent authority space. Action 14, amazingly enough to me, seems to be working. There is some pressure that's being applied through the peer review that's effective, and there's also the transparency that's coming out of the new stats that were never on the table until 2016 in the OECD. Unfortunately, by the way, the stats and the statistics available on the U.S. have actually gone down because the OECD standard is actually a little bit less than what the U.S. used to publish. But that said, this is a really important development, and I am hopeful that the progress, APAs will be a part of that, but we're probably going to have so much going on that we're probably going to need even more. It's because it is a very intensive process, APA at least.
Well, my question is really rooted.
That's not working.
There it goes.
My question is really rooted
Oh, just tell me your question, I'll repeat it.
in a much broader sense, as you were just referring to, the administrators getting together and with intellectual honesty and transparency, applying the rules that they applied in coming to agreements, and then using those rules across the board.
Yeah, I would agree, and Sam actually did some effort when he was running things in the IRS, trying to create safe harbors, using the APA program and some of that, but you found it to be was a heavy lift, and in that time, at least it didn't go.
Yeah, it's really, it's an investment, and we just didn't have the horses. But governments come at this from a different standpoint. So you look at our 2 biggest trading partners. One thought that getting that range was a science, down to the 100th of a decimal point. They agreed with the classification of the entities. The other treaty partner, they would agree to 1% or 2%, but they wouldn't agree that it was a distributor, right? I mean, it's.
Yeah,
very hard.
They're complicated things, but you got your finger right on a real hugely important point. Yeah. Listen, we're over time. I want to thank you for listening to us because we had fun. Thank you.
Thank you.